This is Matthew Cratter from Trader University, and today I want to talk about whether there's a Fed taper tantrum coming. Don't worry if you don't understand what a taper tantrum is. You will understand it by the end of the video. This tantrum metaphor, of course, comes from the world of toddlers, and we're talking about the stock market here as being a bit of a toddler that throws a tantrum if it doesn't get what it wants in the way of low interest rates and asset purchases by the Fed. So this came out yesterday in the process of releasing the Fed's minutes from September. They're always released about a month later. And what we found from the minutes is that the Fed said that it could begin the gradual tapering process by mid-November of this year. So just to back up, the Fed, the Federal Reserve, is a central bank in the U.S., and currently it's buying about $80 billion worth of government bonds, called Treasuries in the U.S., and about $40 billion worth of MBS as mortgage-backed securities. These are securities that are bundled up mortgages. When you take out a mortgage on your house, it usually gets sold off and bundled up in these securities. So the Fed, by doing this, is keeping interest rates low, and it's also propping up the housing market. Now, obviously, if you've been trying to buy a house, you realize the housing market does not need to be propped up. We actually have the opposite problem where it's going up too quickly and rents are going up too quickly as a result. But right now that this is what the Fed's buying, they're buying about $120 billion worth of securities every single month, and then they're adding these securities to its balance sheet. This is called quantitative easing. Quantitative easing is just a fancy word that's meant to cover up the bare fact that we have an institution that's basically part of the government. You could argue whether the Fed is a private bank, but basically it's one arm of the government printing up money and buying debt from another arm of the government. This is actually insanity, and only modern economists and central bankers could think of something like this. This right here is the Federal Reserve's balance sheet. These are the assets that they're holding. So they print up some new money, some new dollars, they devalue the dollar in the process, and then they buy these assets like Treasuries and MBSs and add them to their balance sheet. We can see really since the start of the pandemic, their balance sheet has gone from about $4 trillion to about $8 trillion. So it's gone up. It's basically doubled. And we're talking trillions. These are very, very large numbers. So here are the minutes from the Fed that were released yesterday. These are the minutes of a meeting that took place September 21st through September 22nd of 2021. And I will link to this below. And I should say right here, if you're finding this video helpful so far, be sure to hit that subscribe and like button. Maybe share this video with a few friends as well so we can increase viewership on this channel. So I'm going to be quoting now from these minutes that were just released yesterday. And in these minutes, they suggest that they're going to reduce the pace of asset purchases. This is what a taper means. It means you taper your buying. You buy less each month. And so they want to reduce it by $10 billion a month in terms of their treasuries and $5 billion a month in terms of their mortgage-backed security. So that would mean that they're going to be buying only $70 billion in treasuries every month and call it $35 billion in mortgage-backed securities. They observe that by giving advance notice to the public of this plan, they may reduce the risk of an adverse market reaction. What happened when they tried to taper in 2013 was the stock market crashed and sort of called their bluff, and they had to stop. This time they're trying to give a little bit more advance notice and in this way prevent, or at least theoretically prevent, a stock market crash. And then, of course, they have the disclaimer that if something changes, they could adjust the pace of moderation of purchases. In other words, they could stop the taper if the economy turns down, for example. Now, in terms of the timing of this, they suggested that it could begin December is the most likely time, though mid-November would be the other most likely time. And then the suggestion was that this would, the tapering would be complete by July of next year. What this would mean is that they would no longer be buying anything and adding it to their balance sheet. And they noted that this timeline moves everything up by about 1 or 2 months than was previously indicated. Now, why would the Fed need to be doing this? Well, they're obviously worried about inflation risk. And as we talked about yesterday, inflation is everywhere and it's quite severe. Here's commodity price inflation. All the energy complex really up anywhere from around 100% to 120%. metals up, industrial metals up, food up, sugar, wheat, soybeans, etc. Coffee up 100%. So this is the problem. We're seeing it come all the way through to the consumer. The CPI, as we talked about, the consumer price index was up 5.4% year over year. The price of beef, the price of pork and eggs and TVs and just everything you can imagine. So this is why there's pressure on the Fed to taper. But it's important to notice that tapering just means that they're buying less stuff. They will still be buying treasuries. They'll still be manipulating the treasury and mortgage-backed markets simply because mortgage-backed security markets, I should say, simply because they are so big. They're such a large player. As such, when you look at treasury yields, when you look at the 10-year note yield, these are not market-determined yields. These are highly manipulated yields. Mortgage rates, mortgage interest rates should not be as low as they are. Treasury rates should not be as low as they are. They're only as low as they are because we have this huge buyer in the form of the Fed. So tapering does not mean shrinking the Fed's balance sheet. Remember, this is their balance sheet that's at $8 trillion. If the Fed did a full taper, in other words, they stopped their monthly purchases altogether, their balance sheet would still be north of $8 trillion, even if they do a full taper by, say, the summer of 2022. Now, their balance sheet will slowly what's called roll off as these treasuries mature. So it will naturally sort of shrink over time without them even selling anything. But it's important to distinguish between tapering, where they slow their monthly purchases, and actually scaling back or reducing their balance sheet. Now, in the popular press, this taper is really being, or the stimulus, this quantitative easing, is being called emergency pandemic support. And it was obviously instituted under the guise of providing support for the economy, starting with the pandemic in February or March of 2020. But I would suggest that quantitative easing, this Fed printing of money and buying assets, is not emergency pandemic support. It's been going on since 2008, since late 2008, early 2009, the great financial crisis. They have been expanding their balance sheet quite rapidly, and there were no pandemics here. In fact, the economy did quite well. The stock market did quite well. The only time the stock market did badly was really in 2018, when we can see here the Fed tried to shrink its balance sheet. So to pretend that this is totally driven by the pandemic, I think is disingenuous at best. This is not quantitative easing for the Fed. Is not emergency pandemic support. It's emergency late debt cycle support. The U.S. and all the developed economies are at a point now where there's so much leverage in the system, there's so much debt relative to GDP, that the central banks are forced to set in. We are at the end of this long-term debt cycle. And as such, things have gotten really weird. Interest rates are very low. The Fed, basically the U.S. government, is issuing debt from one hand and buying it with the other hand. And as a result, it's completely hurting everyday people. Housing prices, stock prices, gas prices, grocery prices are through the roof. When real estate and stock prices go up, it disproportionately benefits the wealthy and increases wealth inequality. So this is actually a very big deal. But what a lot of people, I don't think, realize is that the Fed cannot taper for long, and they certainly cannot reduce their balance sheet. The U.S. government's currently bringing in about $3.9 trillion in tax revenue while spending $7 trillion in government spending. So there's a budget deficit that's basically a difference between what you bring in and what you spend, a budget deficit of about $3.2 trillion. And this needs to be made up for by issuing debt, by the U.S. government borrowing, by selling treasuries. If we divide this out, if we assume that this continues, and it should stay at these levels and even go up, simply because Medicare and Social Security payments will continue to increase over this decade as the boomers retire. So this big hole in the budget is unlikely to shrink. You could confiscate all the wealth of all the billionaires in the U.S., and it would only buy you a small amount of time. These are large structural problems. If we assume there's a deficit of $3.2 trillion annually, if we divide that by 12 months, it means that the U.S. government needs to issue $266 billion of new debt. They need to roll over their existing debt. In other words, they borrow to pay off their existing debt, and then they need to borrow more in addition. So $266 billion in new debt every month. The Fed's currently buying a huge percentage of that. It's buying $80 billion out of that. And to the extent that this budget deficit increases, it means the Fed, rather than tapering, is actually going to need to buy more and more treasuries. And I would point out, if U.S. treasuries are such wonderful, pristine collateral, they're currently the global reserve asset, and they replace gold in that respect, why does the Fed need to keep stepping in as the buyer of last resort? Well, this is simply because our federal debt used to be held mostly by foreign and international investors. We can see here over the past 5 years, the foreign holdings of U.S. Treasuries of debt have gone up about $1 trillion, so 6.2 trillion up to 7.2 trillion. So that's increased about $1 trillion. At the same time, the amount of Treasuries held by the Fed has gone from 2.4 trillion to 5.4 trillion. So it's gone up 3 trillion. Basically, the Fed is taking over as the buyer of last resort simply because foreign investors, foreign central banks, international investors, international pensions, they don't want to hold our debt anymore. And so this has much less to do with the pandemic and a lot more to do with the huge mess that the U.S. is in. The U.S. is at the center of the global financial system, and the U.S. is actually in a lot of trouble. And we're going to need to devalue our money, the U.S. dollar, in the process of trying to get out of this. As I mentioned, the taper tantrum was when the Fed decreased its purchases in 2013. That was the first one, but the really big one happened when it wasn't really a taper tantrum. It was more like a balance sheet reduction tantrum. The Fed tried to shrink its balance sheet, in other words, shrink this chart. Basically, you can see it happening in late 2017, really going through the middle of 2019, the Fed letting the treasuries roll off the balance sheet. When that happened, we got a mini stock market crash. So this is the rock, and basically the Fed is between a rock and a hard place, or between Scylla and Charybdis, as we've said in a previous video. And if they try to, on the one hand, they're being attacked by inflation, which really gives rise to more populism, gives rise to social unrest. And then on the other side, if they actually try to shrink their balance sheet, it crashes everything. And I'll link here. You can read about what happened in 2013 when the taper tantrum happened. So here's my prediction. The Fed will continue to taper, and it's currently just going to do a small amount. Whether it starts in November or December, it will reduce its monthly purchases by 5 or 10 billion, and it will continue to do this and sort of telegraph it. So when the Fed says they're going to do something, it gets priced into the markets. They don't actually need to do it. And so people who think that if the Fed does this in November, we're going to have some big crash, are wrong, in the sense that this has been telegraphed to the market and it's basically already priced in. Stocks are up this morning. Everything looks fine. It looks like the market can handle this. But the real question is what the breaking point is. It's a little bit like adding sand to a sandcastle. At what point does the last grain cause the entire thing to collapse? And the current financial system is actually this fragile. So it's highly unlikely that the Fed will actually be able to shrink their balance sheet without triggering a sharp stock market sell-off. They will continue to taper. Maybe in November, December, they'll announce that they'll taper a little bit more in January, and they will try to reduce their monthly new purchases to zero. I predict that in the process, we'll get a hiccup in the stock markets. The markets will be calling the Fed's bluff, and the Fed will have to stop tapering. This is the problem. If the Fed tapers too hard or actually tries to shrink their balance sheet, and you end up with an asset price crash, stocks go down, housing goes down, what this means is you have fewer capital gains, which means lower capital gains, taxes being paid in, which means tax revenues are lower, and then the federal government's fiscal situation gets even worse, and they need to issue even more treasuries in order to plug that deficit gap. And when they issue more treasuries, since international investors are not buying them anymore, or at least on the margin have really reduced their purchases, that means the Fed will need to buy it. So this is really a gigantic mess that we're in. This is the most important point to remember, though. The Fed will need to continue to buy treasuries for the rest of the decade. You can take a look at the U.S. debt clock. There's no way out of this unless magically we can get the whole world to buy more of our treasuries. And so as a result, because of this, this means that stocks will continue to do really well, housing will continue to do really well, and Bitcoin will continue to do really well. Stocks and real estate, it's not necessarily that they're going up, it's simply that the purchasing power of the US dollar is going down. I think Bitcoin's in a slightly different situation because it has increasing adoption. Bitcoin doesn't just need the US dollar to crash for it to go up. It's going up simply because the value of the network is going up as well. But this is the problem if you need to sell a lot of debt to the world and then you go around and make everyone angry. We certainly can't expect Russia to buy our debt after the way we've treated them, constantly freezing accounts and doing sanctions. And I'm not going to weigh in on whether this was right or wrong geopolitically. All I'm saying here is that when you attack Russia, when you attack China, and obviously China probably wants to attack us too, but the general point here, apart from geopolitical concerns, is when you make these purchasers of our treasuries angry, it means that's much less likely they're going to buy more treasuries. And as a result, the Fed has to step in and be the buyer of last resort. So we'll see what happens with this taper tantrum. So far, it's going smoothly. At some point, really depends on what sort of spending bills get passed by Congress here and how big they are. But the Fed will need to continue to buy. This is a little bit of a bluff, trying to slow down, I imagine, commodity price appreciation and slow down asset price appreciation. But the market's handling it fine, at least today. Stocks up sharply today. So we'll see where this takes us. The one thing that I think is highly, highly unlikely is that the Fed will ever be able to shrink its balance sheet again. I think it's much more likely that they will need to continue to buy new treasuries and buy mortgage-backed securities, but certainly new treasuries in order to plug the fiscal budget deficit. If you found this video helpful, be sure to hit that subscribe and like button. Hit the notification bell if you want to be notified when I publish my next video. And let me know your questions and comments in the comment section below. Thanks a lot for watching, and I'll see you in the next video.